We're joined now by Philip Chan. Philip is the director of Shenyin Wanguo Securities. He's joining us from Hong Kong, and also Stephen Sheng sitting right next to him from SHK Private. Thanks to both of you guys for joining us on the show today. Philip, I want to talk to you a little bit about investing in China, because I know you've been looking at sectors that will benefit if we get more stimulus in China. But the big question is, where's the PBOC? What are they going to do, and when are they going to do it?
No, well, of course, that's a good question, but I don't think they're going to be doing much, during this leadership change. Most commentators, including our own economists, are looking for, RRR cuts and maybe even a cut in interest rates. But the thing is that the economy is slowing down to the extent that maybe they don't really need to move on that, or there's no big pressure on them to move on this issue. So I think in the short run, probably not much is going to happen from the PBOC.
And Philip, what's the logic in waiting until the leadership change is done and over with? What are they thinking? I mean, if the economy is suffering and everyone's downgrading their growth forecast for China, why wait for the next group to take control so they can simply take credit for an improving economy?
Well, no, the thing is, you see, the economy is slowing down, but it's not slowing down to the extent that you've got a crisis going on. It's still growing at 7%, 7.5% plus, and that is fine in the context of the current sort of global economic environment. I know that people tend to look at this as pretty negative, but actually it's probably more manageable for the Chinese government. So I think it's fine. Yeah.
You're absolutely right that when you compare it to developed countries and the pace that those economies are growing at. So which sectors, first of all, do you think the Chinese economy is starting to bottom out? Because we've had several calls along those lines that, we're pretty much bumbling across the bottom right now. Do you think that's the case? And if so, which sectors should investors be looking at?
Well, it depends on the view you take in terms of whether they're going to stimulate a little bit more. Like I said, we're not looking for them to stimulate aggressively. If they do stimulate more, then we'd be looking at sectors like that will ride a little bit on that. So the cyclical sectors like copper and the banks, because of the high weighting in the index, even construction machinery, energy as well. If you're looking for not much, no stimulus at all, then we'd still be looking at a positive run on sectors like utilities and consumer staples.
Philip, infrastructure, is that a crowded trade?
Not crowded, but if you're looking at infrastructure, then we'd more look at, say, the toll roads, because the slightly more defensive, and I think all the bad news for toll roads has come out already. So there's a yield play as well there.
Okay, Philip, I want to ask you, you mentioned the banks as a sector that could benefit from more stimulus. When they were out with their earnings last time around, NPL ratios hardly moved. Is that realistic? It doesn't really reflect the slowdown that we've been seeing in the economy. Might we see a tick up in NPL ratios anytime soon?
Well, the thing is, the thing you've got to look at with NPLs is that they're still very low compared to global norms. So even if they tick up a little bit over the next couple of years, they're still going to be within global norms. So we're not really too concerned about that. Besides which, in this current round of minor stimulus that we've had, the banks have not really taken up have not been enamored about the lending to new projects. So they're going to be more cautious about what loans they give in future.
Okay, we keep hearing that Chinese stocks are so incredibly cheap right now, but yet investors are afraid to touch them. They won't go near them with a 10-foot pole. Do you think there's too much fear out there and an overreaction to what's happening in China on behalf of investors?
Yeah, there is. This rally that we've had in Chinese stocks in recent months, that's not really been supported by largely by foreign investors. That's really just been, as you can see, by the low trading turnover. So I think that there has to be some catalysts for foreign investors to come back to the Chinese markets. And of course the local markets in China, like the A shares, we don't expect those to pick up until the local investors are fully fully going in on conviction, and right this moment they're not.
So, Philip, does that mean that we need to see more QFII type measures and further opening up and liberalisation of China's capital markets?
I think those will help, but in the context of the whole market, the QFI scheme is very small, so it will be incremental, incremental improvement in the market and help sentiment. Yes, so I think that those things will help, but not in a dramatic way. I think you've got to have maybe some clear evidence that the slowdown has bottomed, and there's a little bit of uptick. Then you'll start getting more interest coming back into the local markets and also Hong Kong listed.
Okay, Philip, pleasure.